You know what's interesting to me? One of the reporters, I forget who it was, just asked Chairman Powell about where's the wage growth? Like, why is it not accelerating through year end? Why did it seem to be faster early this year? I feel as though we need to have this acceptance that the nature of work itself has changed, and the tools we're using to measure things like wage growth and the labor market and participation, they're from the 60s. Like the flexibility of the U.S. worker, the ability to take on different jobs at different times, it doesn't all compute the way you might like to see it. I know there's some realization of this, but maybe less on the media's part. The Fed can't solve that. In addition, you've got this massive generational changeover. You've got boomers retiring at the top of the income scale, and who's replacing them? 73 million millennials in the workforce, joining the workforce. They're coming in at entry-level salaries. That is not, so if you follow one person and their trajectory, you see them getting raises. If you follow it in the aggregate, you will not see quite the same velocity of wage gains that you would expect at this stage in the cycle. So I think we just need to understand, in many respects, we're using old tools to look at a new economy, and you won't always see the data you expect after rates having been this low for this long.
David Zervos, wanted to bring you into the discussion as well, and in particular what you think about the potential pressures on the dollar going forward, because it seems pretty clear we're not going to get a rate hike anytime soon from the Fed. It's plausible now, perhaps, that the next rate hike comes from somebody else, ECB, Bank of England, or Bank of Japan. The rate in absolute terms will still be well below the Fed, but is it plausible that that now happens?
Well, I really don't think we're looking at rate hike stories for Europe, Japan, certainly Japan, or the UK with all the, even after the election. I think that's probably a more far-fetched story. But I mean, look, we've had 3 rate cuts. We've had a significant increase in the balance sheet and a commitment to that. And the dollar is still not that far off of its, multi-decade highs on a trade-weighted basis. So for all the people that, and there are a lot of people out there that really do want to sell the dollar on this more dovish outlook, it's kind of not working as well as people would have hoped, which tells you that there is some underlying dollar strength out there or some shorts in the dollar. And I think the repo market tells you that people are kind of short dollars. They need to borrow them, and the rates they're willing to borrow them at go up in these spikes. So we borrowed a lot of dollars globally during the QE period at very low rates, particularly outside the U.S. And there's a lot of people who might be struggling to pay those dollars back, and there's demand for them. So I'm not averse to sort of some short dollar strategies, but I don't think it's a great trade. I think the trade for this coming year, 2020, is really a kind of a modified version of what happened in the mid-1990s, which is we got the soft landing after the rate cuts, the equity markets took off, and the only difference is we're not going to get the fixed income sell-off that we got in, say, 96 after the 95 rate cuts. Because, as Chair Powell said, this is not the same story as the 90s. This is a very different inflation story, and a Fed which is committed, as Paul McCulley told us earlier and Steve reiterated, the Fed that is committed to driving inflation higher. That was not the case in the 1990s. And it's a very, very asymmetric Fed reaction function. That was the message today. And actually, I think it's a really important message that many in the market have not fully absorbed.